Hi, good
Hi,
afternoon.
hi, hi. I believe KK has freezed, and this is Seshadri here. So, welcome back onto the webinar series Banking and Business Dialogue. And today we have none other than Mr. Udayan Goyal, who is the founding member and partner, investing partner of Apis Group. And welcome, Udayan.
Hi,
Welcome to
good
the show.
morning. Good morning.
Hi.
Good morning.
Yeah, good to see you back on the webinar, and we are glad to mention that we have crossed online 500 attendees on various social media, including YouTube, Twitter, and now LinkedIn, apart from Facebook. Welcome back, Udayan, on the show.
Thank you.
Yeah, today's topic is on financial inclusion in the information age. So uh, we will talk about on the financial inclusion in general to start with, and we would like to have your views on starting with the basic of the bottom of the pyramid from C.H. Prahlad of financial inclusion and going forward, digital financial inclusion. Over to you there.
Thank you. Yeah, so good morning. I think one of the things that we have always been very focused on at Apis has been financial inclusion. And actually, it harks back to when I founded the firm with my partner, Matteo Stefanel. You know, the two of us for many, many years were bankers. We worked together initially at a bank called DLJ, which then got acquired by Credit Suisse. Then we ended up at Deutsche Bank together. And, you know, over those years, we learned a lot about financial services because we were financial services bankers, and learned a lot about how financial markets and financial systems work. And when we came back together in 2014, we sort of were thinking a little bit about, you know, we'd done a lot in our lives vis-a-vis work and the typical career path, and we wanted to build an institution and build a company which was sustainable from a profitability perspective, of course, but also had a purpose. And so thereby was born the idea of profit with purpose. So we wanted to make a change by using capital to be catalytic, but more catalytic than just allowing companies to grow. So actually to drive change within the markets that they tapped. And I think the biggest point at that juncture when we started Apis was that many countries had very, very strong, fully functioning financial services ecosystems and markets, etc. And yet there were many people in those markets. India was a great example at the time, China, others, where a lot of people just didn't have access to the formal financial services system. And you sort of thought, well, that doesn't make a lot of sense, because actually you need financial services to do really anything in an economy. So if you think about anything in the value chain that you have to do, you have to pay for that. And the payment part of it requires, you can do it one of two ways. You can either use physical cash, which is highly inefficient because you need to be in close proximity with each other, or you can use electronic cash, which allows you to do it digitally, easily, frictionless typically. That's at one level. At a second level, if you think about a rural consumer, if you think about somebody in a very rural oriented market, that person, he or she, so let's take an example of a farmer. A farmer will have a crop every year. Typically that's one crop a year, sometimes two, but in most cases one crop a year. So every year that farmer has one large cash flow event. That cash flow event, when it arrives after the harvest, the farmer takes whatever crop he or she has harvested over to a wholesale buyer typically, and the wholesale buyer will pay the farmer a certain amount of cash. Now, the key for that farmer is to be able to make that cash last for the following year. The farmer needs to reinvest in the crops, i.e., buy the seeds and thereby reinvest in the crops, and then also has to have enough savings to sustain the family through to the next harvest. And in a situation where that farmer is purely dealing it in cash and is not formally included in a financial services ecosystem, you then have problems. Now let's give a couple of examples. The farmer's child gets ill, seriously ill. You have to bring a doctor in. Doctor comes in. Farmer needs to pay for the doctor or the hospitalization. All the money is gone. The farmer now has an issue. The farmer needs to borrow. Now, in these sorts of situations, the farmer has to borrow, ends up borrowing from the old school money lenders who charge usurious levels of interest. And then you get into what's called the debt spiral, and it becomes a very difficult situation. Now, let's take the other example. Farmer gets the crop in, gets the money in, puts the money into an electronic bank account. From that bank account or some form of stored value system, that money is now earning a return. So that's number one. Number two, because the farmer has shown regular income, the farmer can actually get insurance. So let's say medical insurance, some form of insurance. He can even get he or she can even get crop insurance for a failure of the crop next year. So that starts to smooth out the cash flows for these extraneous events like illness or let's say crop failure, many of the other things. So you start to see how that works for that farmer. And then the farmer is able to build a history, which, in case the farmer wants to expand, the farmer can get credit to, let's say, buy more fields, to do different types of crops, and to expand. So that's the first level. So you can see how inclusion can be very catalytic to changing people's lives. That's the first level. At the second level, if you start to think about that money then can goes into a system, and that money can be reused because the institution that's taking that money can intermediate it and actually lend it out to other people, and that capital can be reused and flow. And that actually is one of the key learnings of financial inclusion. A number of years ago, I think the Boston Consulting Group did a study and showed that every percentage increase in financial inclusion in a market resulted in an increase of GDP growth by 3.6%. So there was a direct correlation between financial inclusion and GDP growth. And so that prospect, that idea of increasing financial inclusion and thereby driving a lot of GDP growth was something right at the cornerstone. As I said, coming back to when we started Apis, we really wanted to sort of build a company with profit with purpose. And at the heart of it was this idea of financial inclusion.
That was wonderful, Udayan, and we got a real perspective of the basis of financial inclusion being inclusive to the whole masses. And this is very applicable to the Indian scenario, where the majority of the masses earning income are the farmers, self-employed farmers. And this is a news to us that the financial inclusion directly it gives increase and boost of GDP to the country, which is eye-opening for us. Thank you, and thanks a lot. And over to KK.
Yeah. Sorry, Udayan, I'm back.
Morning, KK.
Some technical glitch, and welcome everyone. I'm sorry about it. KK, your host for today. So we talked about financial inclusion. I've been hearing you, Udayan. So despite the push that the central bank has given to financial inclusion, and you rightly said about the 1% increase in FI can give a push of almost 3.6% per capita in the GDP. Despite the central bank push and despite the government's Jan Dhan plan to give that a push, the World Bank's global index pegs India at somewhere around 65%. So could be plus minus since the report came. So if the full financial inclusion is not happening in India, and probably not even progressively by most important metrics, why is this the case, and how we might improve this?
It's a difficult question to answer, and it's largely a difficult question to answer. So I mean, India is a great example. I want to go back to a little bit. One of the key things to build financial inclusion is like in any um, type of market is infrastructure. So just like you build roads so that you can go from one place to the other efficiently, in the same way, you need to really build financial infrastructure to be able to go from A to B. And I think India has really been, in my mind, a pioneer in building the underlying infrastructure to develop financial inclusion. So I think many of you may be familiar with something called the India Stack. The India Stack is a set of technologies that have four distinct layers. Just to recap for everybody, there's the concept of the presenceless layer. That is the concept of identity. We've talked about it before. So you have a biometric identity protocol through something called Aadhaar, which everybody's familiar with. And that allows anybody to be identified using biometric information, which is the most efficient way to identify people with the least amount of issues around, let's say, stolen identity, security issues, etc. The second layer in that being built is the cashless layer. Now, again, everybody's familiar. We have something called UPI, which was the second iteration. The first was IMPS. In both of these iterations, you can move money from account to account in India very efficiently, very, very reasonably. And so it creates this cashless layer, which allows people to move money with very low friction and almost basically replace cash, because cash is the most efficient way of moving money from A to B, because really, as long as you're physically present with everybody, there's no cost. The problem with cash is actually handling cash is very expensive, especially for institutions. So people don't often factor in that real cost of handling cash, right? So this cashless layer really takes it out. The third is an idea of the paperless layer. And I think, again, India's been a real pioneer of building the idea of a digital locker where you store your driver's license, your birth certificate, your passport information, um, your graduation transcripts. All of this can be stored in a way that's easily accessible up in the cloud using the presenceless layer to get authentication, to get access to that. And again, was very much a pioneering layer. And then the fourth aspect of this is the consent layer, which is again very important, which is I can give somebody consent to access, let's say, my digital locker. Actually, interestingly enough, this was something I'd worked on almost 10 years ago with Swift. We worked on it, and actually we presented it at Cybos, which is something called the digital asset grid. It was exactly this concept where you own a bunch of digital assets, and to give access to people, you have a consent layer which allows them to get access to that. So let me give you an example. Right today, Google collects a lot of information on all of us, right? Because we use the internet, etc. Until recently, without legislation like GDPR in Europe and the various data protection regulations, we were working on implicit consent, as in we implicitly provided consent for Google to use that data to be able to provide us services. With GDPR in Europe, we've now moved to explicit consent, which means that you must get my consent explicitly to use my data. Right? And this is again the idea of the consent layer, which exists as part of the India stack. Now, with this India stack, what we've been able to do in India is really build really interesting systems to reach, let's say, the rural unbanked or the unbanked. Everybody in India can have a bank account easily. They can open it just with a fingerprint. The idea being that over time you can move the entire benefit system into the cashless infrastructure that's been built. Now, to answer your question, KK, the reason I think we haven't quite got there, and you talk about the statistics, is that this is a work in progress, number one. And number two, I think until the government of India moves to completely cashless disbursement of benefits to people, we will continue to have a very significant cash-based economy, and therefore people will continue to use cash away from the usage of these cashless systems. That's number one. Number two, obviously, one of the key things that people have been using cash for in every country around the world is to avoid taxation. And as we move into more efficient systems and more fairer ways of doing taxation, which people are bought into, I think the quicker that people get into. There are a multitude of factors that sort of look at the balance between the cash economy and the cashless economy. And I think an inclusion is very much sits in that cusp of the cashless economy and the cash economy, because you'll still have a lot of people. There's been a lot of talk in India about migrant workers. Until migrant workers have really a very easy way to access their money electronically, which today they don't, they will continue to be very focused on cash, because when they move from A to B, they want to be able to carry their value with them, right? But if they can have an easy way to access the cash. Now, you look at a country like Kenya, which has a system called M-Pesa, which is a mobile payment system. It's a very vast, very well used system to move money around. And people, because of the convenience and the ability to pay people over long distances, that really allows people to play that game very, very well. And then you've again built lots of interesting systems. So let's just use the Kenya example. Around M-Pesa, because people use that to pay bills and everything, you can build a sort of transactional record on yourself, and that transactional record allows you to therefore get loans because you've got a transactional record. And that's the second order of financial inclusion, because the idea of bringing people in then allows them access to what I call these risk products, which is, let's say, loans or insurance. These are all risk products, which then allows them to smooth out their cash flows.
Yeah. Thanks, Udayan. What about the role of the technology? Banks have, in general, have not been able to get much on the financial inclusion technology that they have used. And so is it time for the fintech companies and the banks to sit together, collaborate, and come out with some low-cost innovation such that they can drive the financial inclusion to a next level?
Look, I think with anything in life, you have to have the right motivation to do something.
Right.
You cannot force the banks. And by the way, this was tried out with, the Prime Minister's bank account scheme and all these things that happen in India. You cannot force people to the table to do something if there isn't the right motivation. So if you're forcing banks to do something that's a loss-leading product, it's
Yeah.
not going to work for them, because they'll do it for some time because it's part of their CSR, and at some point they'll walk away because they have, their job is to deliver profits to their shareholders, right? Assuming they're a non-mutual institution. If they're a mutual institution, they're supposed to deliver benefits to their customers, right, as a whole. Now, I say that because one of the key things that we invest in is sustainable businesses. We want them to be doing uh, good work around the inclusion. We want them to be catalytic in inclusion, but we also want them to be profitable. Why do we want them to be profitable? We want them to be profitable because that makes them sustainable. Because if you think of a business that's purely working on grants, once the grants dries up, the business is no longer sustainable. It falls by the wayside. So you want something to last forever. And sustainability is a very important part of this equation. So coming back to the point, fintechs and banks coming together to do something, it has to be driven by the right motivation. And that motivation for most institutions is going to be the ability to deliver profit. Right? Now, most banks, I would say pretty much all, but let's say most banks, have an issue. And that issue is they're built on a certain legacy. That legacy has a certain cost base. That legacy cost base means that their price point for delivery of services to customers tends to be fairly high. Now, what that means is that in order for them to deliver services to people at a lower price point, so let's say the rural unbanked, which is in one customer segment, they're unable to structurally make that business profitable. It's just not possible for them to do it because their cost base does not allow them to do that. Whereas there are, as you call them, fintech or much thinner companies or younger companies that don't have that legacy cost base that can deliver those services to those customers using the wholesale underlying infrastructure that the banking sector has set up. Now, we talked about this in previous discussions, the concept of open banking, and open banking allows these institutions or these fintechs or whatever you want to call them to get access to data that sits within the bank, to get access to the infrastructure, the regulated infrastructure that sits within the banks at a wholesale level. And they can buy those wholesale services and repackage them and sell them to, let's say, the rural unbanked and build a profitable business and deliver that profitable business. So I think you have to think about it conceptually as this idea that you've stratified the value chain. You're picking the value chain on the distribution end, repackaging wholesale. Now, there's a great example of this in India. For many, many years, as you may know, Unilever, uh, when it first came to India, really struggled and it really struggled to make money because they used to sell consumer goods, durable consumer goods, basic, not durable, non-durable consumer goods. So shampoos, toothpaste, all these things in large packaging, right? So what you see in all the world, you buy a toothpaste in a large tube, or you buy a shampoo in a 400 or 200 milliliter bottle, right? They realized that the problem, the big issue was that they couldn't sell to the vast majority of people because the vast majority of people didn't want to buy in such large quantity. Their cash flows meant that they had to buy in very, very small quantities, but much more often. So, what did Unilever do, or what did many of the companies, Dabur, Unilever, whoever you want to uh, look at in that space, do? They repackaged their shampoos into sachets. They
Yeah.
repackaged their toothpaste into smaller sizes, and they started to sell it. And suddenly, they became massively profitable because they realized that they could essentially serve that customer base at a different absolute price point. And I think the way you need to look at the banking paradigm is exactly the same. Today, we deliver the banking paradigm and the banking products at a price point which is like a 250 milliliter bottle of shampoo. And there's only a certain segment of the population that can afford to buy that 250 milliliter bottle of shampoo. If we move to a 10 milliliter sachet for the same product, and deliver it via a cheaper mechanism. And when I say cheaper mechanism, you don't use physical infrastructure the way the traditional legacy do. You use digital infrastructure through smartphones. And obviously, you had a proliferation of smartphones and feature phones and data, and you looking at geo and the way geo is going right now. Once you deliver that at that different price point, that market is actually a very interesting market to serve, and you can build a very profitable business on the back of it. And so I think you need to, that's how you really need to think about the delivery of those services.
Thank you, Udayan. Okay. So, your perhaps your experience on financial inclusion, or your touch point, was with the story of water, which you did speak about in the TEDx. And based on your experience since then, can you please elaborate upon the transformative technology-led business models that have accelerated digital financial inclusion, and what are the key takeaways from there?
So let me go back to the example you used. So as you rightly point out, many years ago, I now almost forget how many years ago, I've been a regular attendee of a conference called TED, which I'm sure a lot of people see
Yeah.
on YouTube, etc., with the TED Talks. But it's actually a proper conference that typically happens. Originally was in California and then moved to Vancouver. And one year, many years ago, TED decided to do a conference in India. Actually, they did it at the Infosys campus near Mysore, and so I went to attend that because I thought it'd be really interesting for me to go to India and see. I mean, in terms of just seeing TED India, they curated lots of very interesting speakers. And on my bus ride on the way from Bangalore airport to the Infosys campus, where they were picking us all up, I sat next to a guy called Anand Shah. And Anand was actually introduced to me in a funny sort of way because his brother, I also knew his brother, Jigar Shah, who was a very well known climate change activist based in Washington, D.C. And we had chatted. And I didn't know that when I sat next to him. And of course, small world
Yeah.
connections and all of that. So I started to chat with Anand, and I said, "Hey, Anand, what is it that you do? It'd be just interesting." He was a TED fellow, right? So he was one of these people who'd been invited because they do something quite interesting. And so he said, "Well, I deliver clean water in villages." So I said, "Okay, that's quite interesting." And so he was the CEO of a company called Sarvajal,
Yeah.
which as you know, in Sanskrit means the delivery. It basically means water for all in Sanskrit, and which is backed by the Piramal Foundation. And he had gone to, I believe, Wharton, which was one of the best business schools in the world, and he had come back to India, and he wanted to work in a social enterprise, and he got interested in the social enterprise and ended up there. And so I said, "Okay, tell me a little bit about this water thing you got going on." And he said, "Look, we started out. I think what people don't know is that the vast majority of disease in India and actually anywhere else in the world is as a result of people drinking contaminated water. So in most in most locations, rural, urban, Africa, it's particularly bad. India has got a lot better over the last few years. A lot of the sewage ends up in the drinking water supply. That is a total disaster because you get a lot of disease as a result. So if you can drink clean water and if you can give your children clean water, you can literally eradicate 90% or 95% of disease immediately from a village. So he came to this conclusion. Now, what they did was they used to build these um, waterification, and they'd put it into a village, and then they would go to the next village and build it. But the problem was they couldn't make it sustainable because at some point, coming back to my point about sustainability, at some point the money runs out. How do you make this whole thing sustainable? So they said, you know what? Let's go, and going back to my other example, we can't sell the plant to a village. It's too expensive. I think the plant costs like 5 lakhs. I don't remember the number, but it was a reasonable sum of money. And you can't sell it because only so many villages can afford to buy the plant. And even if we finance it, we can only afford to build so many. So how do we make it sustainable? Let's go back to the Unilever example. So we now make it bite-sized. So let's not sell the plant. Let's sell a liter of water at a time. And let's sell a liter of water at 10 paisa a liter. I'm just using a number. So now suddenly, because you're selling to people, 10 paisa a liter is affordable for everybody. And what was interesting was that the minute villagers realized that the minute they were drinking this clean water, nobody was getting ill, they were hooked on this stuff. So they were happily paying the money. Then came the second problem. And the second problem was that they were collecting all this money, but they couldn't get the money from the village back to headquarters so that that money could be reused to buy more plants and put them into more locations. So it was an interesting thing. This is the paradigm of cash that we were talking about earlier, right? Because the cash was coming into the village. The person, they had an agent, or they had a franchisee owner who used to run this kind of business, and he or she would have all this cash but couldn't get it up to the front. So then he said, okay, you know what, we should look at technology to find a solution. And the technology that they found as a solution, interesting enough, was prepaid cards. So how does that work? So how that worked is that that they created prepaid cards that they would hand out to all the villagers. And then the villagers would actually charge the prepaid card, just like you charge airtime for your phone, which is a very efficient system in India, as you know. As you know, you can buy airtime in the smallest village. You can find somebody who will sell you the airtime because they've created the pyramidal structure to move for that cash to move back to the headquarters. So they just replicated that pyramidal structure of getting the cash back. Just in the same way you sold airtime, they were selling water credits on the card, and everybody would have a card. They'd walk to the franchise owner, they'd tap the card on the system, and the system would give them the water. And then the whole system became massively efficient. And I love this because it was really sort of a eureka moment for me where I said, oh my God, this is a piece of technology that I'm so familiar with. And yet the ability for this piece of technology to make a gigantic change to people's lives is, I couldn't fathom how big it was, right? And so that was how I sort of thought, well, there must be a lot of other technologies that we can look at or we can reuse that can be catalytic from an inclusion perspective, right? And so actually, interestingly, when Matteo and I set up the firm, one of the first papers we wrote was a paper, and we have all these papers on our website, but one of the papers we first wrote was a paper on reverse innovation. And the concept was that, coming back to a number of the concepts we talked about, that have you moved to these bite-sized type systems and you build an infrastructure that can service people at a very low price point, the opportunity set is that you can use the same technology and take it back to bigger and more developed markets and actually be very, very profitable because you built an infrastructure that supports low price points, and now you're selling it into very high price points. Concept which was coined by a professor and somebody I believe at GE at the time. That this concept is very, very is remarkably prevalent in financial services because many of these interesting technologies, and when I say technology, it's not just technology in the traditional sense. Technology also means business model. These business models that are being built in these markets, these low price points. And so they're using creatively other technologies, repackaging, rethinking business models, and then going out and delivering it to these low price point consumers and building profitable businesses. And this itself then allows you really to go after more interesting markets where you can do that. And a great example of this, for example, I think the way the sector in India is developed and really built some very interesting technology underlying it and business models underlying it. Now in Indian health insurance companies are exporting their technology and their business models to places like the Gulf, where they're higher price points and you can actually do interesting things with them. So those are just some examples for you.
Thank you. So that's great. I think we have, ladies and gentlemen, we have had two excellent examples given by Udayan. One is on the Unilever model, and the other one is the Servagel model. Just for, briefly, could you touch upon, if you are aware of this Bitland? Bitland is in Ghana and Honduras, and Coinbase in USA. Though USA is a very developed country and almost a cashless, if not fully, still there is this P2P system called Coinbase in USA. That should be an interesting model to talk about over there.
We've talked about it in previous discussions around this. These are just manifestations of distributed ledger technology, right? So we said distributed ledger technology and Bitcoin, etc. These are manifestations. The Ghana example, I think, is an interesting example. I actually looked at these companies in some detail as a potential investment. And this is a great example of how you can democratize certain aspects of let's say living in a particular country using this technology. So the way and India is an example. So the way property ownership works in almost every country in the world is largely related to the way the Romans, this comes back to the Romans, the way the Romans set up ownership through what's called a cadastral register, cadastral system. So what you have is you have an authority in any place. In the UK, it's called the land registry. In different countries, it's called something similar. And that land registry will have a register, cadastral register, and that register will say that this piece of property is owned by Mr. So and so, right, or Mrs. So and so, or Miss So and so, and also that register will also, if it's run efficiently, will also have a entry if somebody has a lien on that property. So if you pledge that property for a mortgage or something, it'll also say that this property has been pledged and so is the mortgage owner. Now, the problem is, in many countries, it's not efficient. It's not efficient because sometimes the register is inefficient and there are multiple people who end up owning a property. India's had lots of issues with this disputed ownership. In some cases, people mortgage the property to one person and then to another and to a third bank and a fourth bank, and you don't really know. And until you end up in a bankruptcy situation and everybody pops up and says, well, actually, this property was pledged to me, therefore I should have it. You don't really know who has that. So this is the problem with the legacy of these single point ownership systems that exist. Now, one of the interesting things that you can use blockchain for is basically the idea of taking the coin, so the token that exists within blockchain, and attaching it to the property. So now what they've done in Ghana, what they're doing in Ghana is that they'll take a big tract of a big area and they'll say, we're going to take away this register, do away with it, and we're going to attach each piece of land to a coin. And that coin is basically running on the blockchain protocol. Now what happens is that the ownership is, because the way blockchain works is the ownership, you have absolute clarity on who the owner is. The person who owns the coin owns that piece of property. And you cannot, because the way the system works, you cannot have two people. There's no dispute in that system. Secondly, if you mortgage that property, again, the mortgage is very clear and you can never have a second mortgage because of the way the system works. And I'm not going to go into the technical details, but For those of you who want to have a look at that, you can Google it and find out. But that's essentially how it works. Suddenly, in Ghana, you had the banks who never used to lend against property start to lend against property because they felt comfortable that the risk that they used to take around multiple ownership suddenly fell away. And as that risk fell away, they were able to start to lend and do mortgages. And so you've solved. This is again the idea of using some interesting technology, different price points. You're solving a bunch of issues doing it by taking away that legacy, which essentially has these inefficiencies, bringing something that's efficient. And by the way, this affects people like farmers because farmers before couldn't use their land to pledge or to borrow money, let's say, to expand and all these things. And so suddenly, so the example that you were talking about, like Bitland, which is I think in the property space, Coinbase is a little bit different. Coinbase is more around trading. I think crypto, so that's a slightly different. But this concept is very powerful because you can basically create lots of efficiencies.
Yes. Thank you so much, Udayan. I think, it's good to get a perspective on, I think most people know about financial inclusion as such, but to know what other countries are doing, that's equally important so that they can see how we can benefit out of that. And blockchain very clearly is coming out to be one such example, which we can definitely use. Ladies and gentlemen, as you know that we have this, you can ask your question to Udayan. You can put in your question into the Q&A box and I will try to get it across, or you can raise your hand and we will try and get you across to Udayan. You can ask a question directly to him. So we have Udayan, the first question coming directly to you from Mr. Raghuraman. Mr. Raghuraman, can you please unmute yourself, introduce yourself, and please ask a question. Mr. Raghuraman? Okay. I think he has some difficulty. Maybe a little later on we can bring him on. So, so like I said, ladies and gentlemen, please put in your queries. We are, just about 20 minutes left. So please put in a question so that I can take it across well before 4 to Udayan. So you said about, so can big data and or blockchain provide low cost alternative products and services to drive financial inclusion? I think the answer you said is, and the Bitland case is very clear that you can perhaps bring down cost in this, isn't it, there?
Yeah. So these are great examples of where you're able to bring down significant cost as a result and actually create efficiency, which is the most important thing.
Yes, that's correct. So we move to another area where, and we talked. I know we talked about fintech, and so the fintechs need access to a critical number of customers and or banks or banks infrastructure. While banks have realized that disruptive potential of fintechs is always there. So instead of competing and and cooperation versus competition, there is a new buzzword, as we understand, called co-opetition. Could you tell us, elaborate, what is co-opetition and what is the new buzzword, and is it gaining popularity with the world?
Yeah, it's this word has been around for quite some time, and it's been around so quite some time in the context of actually financial services. And as we I talked about this previously, the stratification of the value chain and the building of APIs between different layers so you can talk to each other. And if you remember, we once talked a little bit about General Motors and how General Motors was a highly vertically integrated organization. And today, car companies don't do anything except for sales, marketing, and design. Neither does Apple.
Mm-hmm.
Apple does sales, marketing, and design. All the manufacturing is done somewhere else. The parts are manufactured, they do the assembly. It's exactly the same in financial services. We're moving to that kind of an environment. And co-opetition is the concept of a collaboration between in the most defined sense of the word is the collaboration between business competitors in the hope of mutually beneficial results. So this idea is that just because we happen to be competitors doesn't mean we can't collaborate. And of course, that's always existed, because if you collaborate in the right way with your competitors, you actually increase the overall size of the pie. So even though you may have the same share of the pie, the absolute amount you're taking away is going to be greater. And as long as you believe that, and I think that is very, very relevant in the context of financial inclusion. When you have millions and billions of people who are unbanked, underbanked, as potential customers, if you can cooperate with your competitors and produce something that brings those people in, the overall size of the pie can increase even exponentially. And so that concept very much exists there. And that is actually one of the reasons why we have in financial services a lot of what we call common infrastructure. Now, the best example of common infrastructure is NPCI in India. NPCI, the National Payments Corporation of India, is technically a cooperative organization that's owned jointly between the government and all the banking sector to produce a payments infrastructure that everybody can use uh, to deliver services. And that's a form of co-opetition because they compete with each other to provide those services, but they're using an underlying infrastructure that's common. And that concept
Yeah.
can exist. You can take it one level up where you have, in inverted commas, a fintech that's using the services of a bank or or any sort of financial services company through APIs and delivering those services out to customers by repackaging, as I talked about earlier. Then the bank may also be competing for those same customers elsewhere or somewhere else, or maybe competing in some segments, but that's fine because the bank is gaining, for example, through selling the product wholesale, and the bank is gaining through selling the product direct. Now, on the direct, they probably have a better margin because distribution has generally higher margins than wholesaling. But remember, when you sell wholesale, you also cover your costs. So your marginal returns become greater on what you're selling direct. And so this is, you have to start thinking about this at all those different levels.
Okay. Yeah. Thanks. So we have a query from one of our participants. They call themselves YT. I don't, maybe yours truly. So he talks about PAC, Primary Agriculture Credit Societies, and he says that the PACs through the DCBs, that is the District Central Cooperative Banks, exactly lends money to farmers against what we call as farm papers. Farm papers is what they use. So based on the paper, which is the land holding, it's already being done. So he says this perhaps needs to be digitized. So what's your take, and what kind of opportunities it may bring on? And maybe the bitland that you spoke about could be an apt case out here.
So yeah, absolutely. I'm familiar with these primary agricultural credit societies. They're kind of form of mutuals, or because they work through these district central cooperative banks that then do lend against these farm papers. You're absolutely right. And obviously, you can create massive efficiencies by digitizing it, by taking away all the physical elements of this, right? For example, the paper being damaged and all of this. So the bitland technology around digitization of let's say land ownership can be used for farm paper digitization. There's no difference. All of this can happen, but it requires an effort, and it also requires legislation and regulation from the government that allows all of this to happen. So and I think there's even a Kisan credit card, if I'm not mistaken, through these societies that provide credit. And so there is a level it's starting to permeate at those levels. But and the good thing is that I love to see some of this technology now starting to have real world applications in these spaces. So yeah, it's an exciting space, and I think it will happen over time. Sometimes these things do take time.
Yeah, I guess so. I'm sure it will happen. Yeah, the reliance on paper is still to hold something in your hand is so important. And but I think over a period of time, maybe holding a token of a blockchain could be the solution as we move ahead. And that, I think, for fintechs, it's a great opportunity out there. We have the next caller call coming to you. I think HP. HP, can you please unmute yourself and ask the question?
Yeah, hi Udayan, this is Harish Prabhu here. The question is that, hasn't the definition of financial inclusion over the last 6 to 10 years, from an Indian context sort of changed? First is through the advent of technology. And the second is, a fair amount of push of financial inclusion driven by the government. And more importantly, from an India perspective, I am sometimes wondering, both from an underbanked as well as unbanked. Now, if you see the structures of India, right from scheduled commercial banks, plus they have regional rural banks, then you have the urban cooperative banks, then you have the rural cooperative bank, district central cooperative bank, primary agricultural credit societies, then you have a lot of, cooperatives and microfinance institutions. So uh, it's a very, very deep rooted kind of a structure, right, in terms of financial institutions. So is financial inclusion only having a bank account, or having access to credit in the revised context? Because I think most of them have a bank account. Or
You're 100% right, Harish. I think that's exactly right. I think it is not about having a bank account. I mean, India, I think, has some crazy statistic. Almost everybody technically has a bank account. The issue is you need to use the bank account, and you need to ultimately use the bank account in order to be able to get access, as I talked about earlier, to these risk products, which includes credit as one of them. Savings is, by the way, the underlying product that you have, and then you have these risk products, which is credit, and then insurance, and these things all become important, and then long-term savings, which is on the back end of insurance. So all of this is incredibly important. How does one get to this? It's by delivery of those services in an efficient and usable way to the end consumer. Now, let's take two steps back. What has really been one of the key drivers, and I go back to when we set up Apis and thought about this. There were two key drivers that were happening globally. One is the proliferation of mobile phones, right? Mobile telephony. As you remember, when I was a child growing up in Delhi, if I had to ring up my relative in New York, I'd have to book a trunk call. It would be booked for the next morning, and at whatever 10 o'clock in the morning, and then somebody would ring me up and connect my trunk call. I mean, today most people don't even have landlines in India. They leapfrog directly into mobile telephony, and now they're leapfrogging, and now they're very quickly moving into smartphones. And the reason they're moving into smartphones is that data, which was very expensive until recently, is becoming very, very cheap. And you can see how geo has really changed the landscape for accessibility of broadband and data, even in rural areas. And that's the reason so many companies are jumping over each other to invest in it, because it really controls a very important part of infrastructure in India. Now, whether it should be controlled by one unit, that's a whole different discussion, which we can have some other time. And and as a result of these two aspects, what it means is that you have the perfect delivery system for these products to the end consumer, which is something that's sitting in his or her hand, which is delivered completely digitally. And by the way, financial products is not a physical product natively; it's a digital product anyway. So the concept of selling a digital product through a physical means branches was anyway kind of antiquated, but existed because of the lack of this technology. Once this technology comes up, you don't need any of that. Now, to your point around the rural cooperative banks and the regional cooperative banks and the district central cooperative banks and this whole crazy infrastructure, you actually interestingly have exactly the same infrastructure in the US, which we consider to be a very advanced nation. They're what called savings and loan institutions, and these things exist at a district, at the equivalent of a district village level. They're all there. And these bankers used to be called 345 bankers. Now, what do I mean by 345 bankers, right? This was a terminology they used for savings and loan institutions, right? They used to borrow at 3, right? Borrow means give deposits at 3%, lend at 4, give loans at 4%, be on the golf course by 5. This was their business model, the 345 business model, because it was very simple. I basically take some deposits, I lend them, I make a spread, and off I go and play golf for the rest of the day. So now what happened along the way? Two things happened along the way. Number one, technology started to come in. With technology, it meant that I could attack the same customers in your district where you had this catchment area where people were kind of forced to use you because they didn't have anybody else to go to, and I could deliver those services to you. And that 4 suddenly became 3.5, 3.25, 3.1, and suddenly your cost base exceeds your returns, and now you're struggling because you need to find an alternative. right? That's the first thing. Then what happened, and as you know, is we moved into a very low interest rate environment. And with a low interest rate environment, your ability to even lend at, structurally at those points suddenly disappeared. And so basically all these banks have been, these sort of savings and loan institutions, be completely squeezed out of the market because their traditional model is gone. And that cost of infrastructure cannot be supported by the new model. And by the way, this is going to be the same everywhere in the world, including India, with all these institutions, right? So we are going to move to mass scale, mass consolidation, and there's no need to have something that's physically located in a particular area, because your ubiquity of the data and mobile phone to be able to reach people allows you to really uh, get jump over all those fences and get to those people very, very quickly. And so these institutions, I think, will over time die out or will get consolidated very, very quickly, one into the other. I think the concept of a mutual society for insurance and a mutual society for savings probably will continue, but it becomes a very niche product for certain groups of people. So, you could have the police in a particular place getting all together. And so you still have these, what they call credit unions in America. They're reasonably, you have the police credit union where they all get together and they're kind of mutual because they all know each other. If you're in part of the police force, you know what people are earning. So the way you measure risk, is very predictable because you have a certain cohort of people that do exactly the same thing, and so you can play that game. So that's a niche product, but this is, I think, what's going to happen. I think to answer your question, yes, that therefore the delivery of these credit services is really what's going to define inclusion, and the technology is going to get there, and it's going to take out this very legacy inefficient infrastructure.
Thank you, Udayan. Thank you, Harish, for asking a wonderful question. So, Udayan, you talked about mass scale, and that brings me to the question of, is financial inclusion possible without a mass movement or a mass scale, as you said? And if we have to build that kind of a scale, what are your suggestions? Maybe one or two points if you could tell us.
Well, I don't think you need to build a scale. The scale is the in every market you have supply and demand. You have supply side, demand side, right?
Yes.
The problem is to reach people. Previously, what you used to use was physical means, a bank branch or whatever it was that you used to use. Today, to reach people, you use digital means through the phone and through data, the data channel that gets through that phone. Or actually, you don't even need the data. You have USSD, which doesn't even use the data channel, it uses the voice channel, and for people who have feature phones. So there are ways of reaching people through that channel. So basically, that means that the demand side is largely solved for, right? Because you have this massive group of people, and all of them you can reach ubiquitously through this channel, right? So then it becomes a supply side point, and the supply side point is designing products that are appropriate that people want to use. And we've talked about this extensively previously around the idea of contextual products, because we don't wake up in the morning to buy a loan. We wake up in the morning to buy something like a car, and then we need a loan to buy the car. It's the facilitation transaction that exists there. And so once you start to embed the products as you actually deliver these experiences to people, it'll automatically, that's the idea of how inclusion will really drive it. One. Number two, and this is why in my mind inclusion is so important, is that if somebody isn't included in that ecosystem, just like if somebody cannot buy uh, goods on the internet, right, they have to pay more typically to buy them off the internet, because the competitive environment for the physical stores is less than on the internet, right? And so what you're doing is you're disadvantaging people by not giving them access to this channel for services and goods and all of that. So it's very important that they become part of that. So this concept of inclusion has many facets, and this is one of the important facets of it.
Yeah, thank you. So I have another query from YouTube. It talks about, to bring down, he says that we can scale up perhaps if we bring down the cost of technology, one factor. So he is referring to a case of a bank, BBVA Bank. BBVA Bank collaborated with a fintech and presented to the regulator for approval. With just opening an account was as simple as just taking a photo and a selfie. That's it. And he said an account can be opened. Are you aware of this? Is this a classic case of co-option? And do you know what is the status of that?
I'm not only aware of it, I'm actually So this is the BBVA Compass, which is a US, which is
Yes.
BBVA's US arm,
Yeah.
and they allow you to take a selfie. I'm not only aware of it because the company that BBVA uses, the technology and the company they use is a company that I originally invested in. It was a company called Simple. It was really the first digital bank in the world. It was actually set up by two guys, one of which happened to be an Indian, Shamir Karkal, and Josh Rake, and they came together. He was ex McKinsey, and they came together. They built the system. I invested in them through my previous company, which I'd also found. I'd invested in them early, and actually both my partner and I, Theo and I, invested in that personally. And
Interesting.
and off we went,
Yeah.
and they built really this system, and BBVA then bought them for, I think at the time, $117 million, and used that technology and integrated it. And that's the back end of BBVA Compass mobile banking app, which is this idea of using the selfie to actually create it, was actually on the back end of that technology. So it was the fintech that they'd bought. Very similar technology for another company that I invested in called Moven, which is run by Brett King, who is a very well-known banking writer. He's written Bank 2.0, which is a New York Times bestseller. So very similar technologies that have been built up. So yeah, absolutely, these technologies there, and they've been built by the sorts of companies that, fortunately, I've had the fortunate opportunity to invest in.
Okay. Thank you, then. We're coming to the end of the show. So before we let you go, a final question on the on what can be done. So we did talk about it. So emerging economies have been the laboratory of innovation. So we did need to talk about the fintech. Can you tell our audience how innovation from emerging economies have been scaled up for developed countries?
I think the best example of scaling up for developed economies is probably mobile payments. So I think
Yeah.
mobile payments really originated in developing economies. The most advanced one in the world is actually Kenya. I talked about it earlier with
Yes. Yes.
M-Pesa.
Yes.
And so now mobile payments are really being rolled out into developed markets very, very quickly, and they're scaling them up. And I think the for example, I think if you look at Apple Pay, which is something that Apple has launched in around the world, and I use it, and lots of people use it. Apple Pay is effectively an evolution of the mobile technology that existed in Kenya, which is using the mobile phone really to make payments. Now, it actually combines two technologies: the mobile payments wallet technology, along with the contactless NFC technology that exists as well. So it brings both of those two concepts together. But all of these concepts, as I mentioned before, a lot of them had originated in these developing markets out of really necessity, and then they've
Okay.
been brought back into these developed markets and are being scaled up.
Okay. Quickly, do you see the digital financial inclusion going leaps and bounds in the next 5 years?
For sure. I think that as technology continues to evolve and as people actually start to apply a lot of the existing technology, I think people will build interesting business models, will attack a lot of the opportunities that exist out there, and particularly deliver services to the unbanked and the underbanked.
Thank you, Udayan. Ladies and gentlemen, we've come to the end of the show. It's past the hour, and we heard a lot about financial inclusion. Most of us know about financial inclusion because in India it's used, but the digital financial inclusion and what's happening outside India in terms of some of the financial inclusions like the Bitland and Udayan touched upon Sarvajal, Unilever way of doing it. I think, and he also touched upon two things that India needs to do perhaps is the perhaps give 100% cashless benefits to everyone. So there is no cash benefit available. And you also talked about the habit that we have to avoid taxation with cash. That is something if we do, I think we will also scale up. And one interesting thing that he did talk about is the 1% financial inclusion scaling up will add to as much as 3.6% GDP per capita, which is a revelation, which is a big number. And jokingly, he did talk about 345 bank managers, but now the cost has come down. So perhaps they are not playing golf anymore, right? Thank you, Udayan, for coming over, spending 1 hour with us and talking about digital financial inclusion. Thank you very much once again for all the information that you've given to us. Thank you,
Thank you very much.
participants. Bye-bye.
Thank you. Good to see you. Thank you.
Bye-bye.